7:46, welcome back everybody. Keep in mind next week is the deadline to file your federal tax return. It was delayed by the pandemic, but the extra time could be a good reminder to those who are divorced to double check their filing because there are tax code changes. Attorney Jonathan Marks from the Marks Law Firm joins us this morning. Good morning. How are you today?
Good morning, John. I'm doing well, thank you.
Fantastic. Say, one of the changes has to do with spousal support if people were divorced after December 31st of 2018. Talk about that change.
Yeah, so, a couple of years ago when they enacted the Tax Cut and Jobs Act, it changes the ability for somebody who is paying spousal support to subsequently deduct it. So it used to be if you were paying somebody what we call spousal maintenance here in Missouri, you were able to then use that as a tax deduction, and the spouse that was receiving it had to claim that as taxable income. Under the current act, that's been eliminated. So as a result of it, no matter what the sum is that you're currently paying for that spousal support, it's no longer deductible to you and it's no longer taxable as income to the receiving spouse.
Interesting. And what about transferring money from, say, an IRA to the other person to pay support?
Yeah, so there used to be a situation where if you were going to try to avoid certain taxable consequences, you could do these spousal transfers on a monthly basis for purposes of using it from IRA to IRA. Well, unfortunately, that also has changed, and as a result of it, the person who is transferring the money from an IRA to pay the support doesn't have the taxable consequence. But unfortunately, on the other end, the person that does receive that IRA transfer, they're going to pay taxes on that as soon as they pull the money out of the IRA. It's going to become income to them.
And if I hire Richard Marks, which I would never do because I'm happily married, you can no longer deduct legal fees or expenses related to divorce.
No, you can no longer deduct those. There used to be a basis that if you were arguing certain aspects of your divorce situation, that you would then be able to come back and use that as a deduction, but that's no longer available as well.
And the next change I was hearing about is there's this new law that eliminates dependency exemptions for children in favor of a larger head of household deduction. Explain that.
Yeah, that's the biggest change, that we're seeing within the court system that makes it very difficult. So when we're now talking about the dependency exemptions, we used to really focus on this for purposes of child support. And now what we're seeing is where we used to give that dependency exemption to the parent that was receiving child support, we're now trying to split it because what used to happen where you could stack those exemptions and have increases, so maybe $200 to $2,500 for purposes of each child would provide you with an exemption and a deduction. You're now seeing that it's just increasing the standard deduction from $2,000 up to about $6,000. So now what you're seeing is when you split those, you're getting maximum dollars between the parents, and then along with it, you start to look at other aspects as how you can help this family as well. So you look at maybe the child tax credit, which would allow somebody to claim up to $2,000 per dependent. You could split those between the households, and then as a result of it, as long as somebody is having a child live with them for at least half the year, it would allow them to maximize the amount of deductions that they could receive so that each household is really getting the more benefit that they can from all of these deductions.
Jonathan Marks, thank you so much for joining us. For more information on these tax changes, we have a link at the Fox 2 mobile app and also fox2now.com. Jonathan Marks, thanks again. Folks, we got to go through